Hello and welcome to NeoSystem's latest webinar, An Introduction to Cash Management. Moving along to our agenda, we're going to be doing some brief introductions, get to know each other a little bit better, and then we'll discuss what exactly is cash flow and the benefits of solid cash flow management. We'll dive into the various approaches to forecasting cash flow, and then we'll share some tips and best practices for managing your cash. Finally, we'll open up to your questions, and if at any point you do have a question, please feel free to use that question box in the lower right-hand corner of your screen to enter your questions. At NeoSystems, we're proud to say, grow ahead, we've got your back office. NeoSystems provides strategic back office services, including accounting, HR, and IT. Our 125 employees provide the depth and breadth of experience to keep all of our clients' back offices running smoothly. This enables them to focus on their customers' needs. Our clients include over 20 of the top 100 government contractors, as well as dozens of companies from 5 to 500 employees. In our secure private cloud today, we host over 500 companies, representing a total of over 32,000 employees. They're running Deltek, GCS, Costpoint, and other applications. With me today, I have Jerry Falvey. Jerry is our Senior Vice President of Client Services. He has over 20 years of experience managing the day-to-day operations of accounting departments. His expertise includes designing and maintaining Deltek accounting systems, as well as working with outside auditors and bankers. He has a CPA, and he teaches a certificate program with George Mason University, Accounting for Government Contracts. I'm Brian Giblin. I support marketing for NeoSystems, as well as lead our product management. As I mentioned, NeoSystems provides strategic back office services, including accounting, HR, and IT. I'm going to focus a little bit more on our accounting. We provide compliant accounting support services. We're talking GAAP compliant, CAS compliant, FAR compliant. We utilize Deltek products to help ensure compliance for our clients. We also provide staff augmentation. Maybe you have someone out on leave, maybe somebody has left and you need to replace them, but you have a temporary need, you need a good qualified accountant right away, or maybe you have a surge in your workload, you need to do some pricing or proposals, and you could use some help. NeoSystems can provide that help. We also provide consulting services. Maybe you need a system review so your accounting system could run more effectively and more efficiently. We can help you there as well. We also provide outsourced accounting services. This is where we do the accounting for you. You have qualified accountants familiar with government contracting and their rules so that your bills, compliant bills, can go out in a timely fashion, as well as you can get your financial statements and all your reports you need to run your business to make informed decisions. Everything we do is hosted in our secure private cloud. We also do consulting for Deltek and IBM Cognos products, as well as providing support for DCA incurred cost submissions. If you're planning to do one of those, we can help you there. Or maybe you've already submitted your incurred cost submission and you got an inadequacy letter. We can help you with that too. We also develop indirect and provisional rates. We design the pool structures so you can bid effectively and recover all of your allowable costs. This will give you a competitive advantage on future bids. Enough about us. What I'd like to do now is a quick poll question so we can learn a little bit more about you. How comfortable are you with your current cash flow management? You know, maybe you're feeling excellent. We've got solid forecasting. Or, you know, you're feeling good. We create some cash flow projections periodically, but we know there's some things we could be doing better. Or maybe you're just occasionally doing some ad hoc analysis. Maybe it's a little bit back of the envelope so you'd rate yourself fair. Or right now you're saying, please help. I don't even know where to begin. Give you a few more seconds of people respond. 5, 4, 3, 2, 1. Let's close the poll. Share the results. Interesting. We got some people in great shape. That's good to see. I'm confident, though, that there'll be some things in here, some tips and tricks that you can pick up that'll benefit. We also have a good number of you. The largest respondents are good. You're creating cash flow projections periodically. We'll have some things there as well. And some fear. Well, there'll be a lot for you to learn in this one. For those who need help, hey, that's what we're here for. All right. Well, with that, I'm going to turn it over to Jerry Falvey and let him take it from there.
Thanks, Brian. Good morning or good afternoon, everybody. Let's go ahead and get started this morning about cash flow. So what is cash flow? It's really just nothing more than the cash receipts that are coming into the company and the cash outflows that are going out there. You can see on the screen that there are several examples of the different types of inflows and outflows that most of us receive and have running through our business on a daily basis. On the left-hand side there, you can see some of the major ones, and most of you probably do get your majority of your cash flows from the collection of accounts receivable for services that you billed to your customers and clients. Probably the other big area of receipts come from the line of credit. If you have a financing vehicle where you need to have that overcome those short-term cash flows, you may have a relationship with a bank, which is going to provide you with the additional source of income. There's a couple smaller ones there, interest income and rebates and refunds. I want to talk about rebates and refunds for just a second here, not so much from the cash flow perspective, but from compliant accounting perspective here. And one of the things that needs to be important is that you cannot really charge those refunds and rebates to other income until it shows up on your income statement. They actually need to be charged back against the cost objective that they were originally charged to or coded to when the transaction went through here. And if you think back to the definition of what as a cost, the total cost is defined by the FAR, it's all of your direct expenses plus your indirect expenses less any rebates and refunds. So making sure that you've accounted for those and put them in against the original charges is critical for when it comes up to looking at DCA reviews and stuff that have one less issue for them to look at and find out. On the right-hand side, you're going to see most of the big things, the big-ticket items for most of us, the payroll, the benefits, the subcontractors. Those are obviously the three probably primary drivers if you're in the professional services building. The first 5 or 6 do look at items that are on the income statement, providing daily operational expenses, but the last ones kind of look at the balance sheet. So that's also important to factor in your cash outflow, that there's going to be transactions that are going to require cash payments that are getting on your balance sheet. One of the common issues there in the bottom left-hand corner questions, it may not necessarily be your cash is negative, but why is our cash balance so much different than the income statement the income showing on our income statement? Very simple reason. That's, accrual accounting is what all of us base our income statement on. It's, that's the principle. When you earn the revenue, you recognize it, and when you incur the expenses, you record them on the books. It's not recorded by the time of the receipt or actual payment of expenses to the vendors. So what are the benefits of doing cash flow projections? Well, there's some very obvious ones here. It's going to give you some visibilities into your requirements for cash. You're going to be able to plan a little bit ahead down the road, short-term and long-term planning, which is obviously important because, again, you need to control your cash flow. It's also going to give you a very good visibility into when you might have a short cash flow. You may have a major expense that you're planning, a capital acquisition, or you've got a new contract wrapping up and you do a cash flow forecast and you can project when the folks are going to have to come on board, and you'll have visibility into what kind of finance you might need. Obviously, this needs to be a living document. It's not one of those things where you can do once a year and set aside and say, that's a great project for January, I'll look at that at the end of the year. A lot of things need to be monitored and maintained throughout the year. Some people may look at their cash annually, just once a year, but it's probably not a real wise way to do things because a lot can change within 12 months. Some of you may look at it on a monthly basis, and again, that depends on how your business is run, what your payroll is. Probably one of the big driving factors is how frequently you take a look at your cash flow requirements. But semi-monthly is most likely the majority of what most of you will look at here because, again, that will sync with your major driving expense, payroll and payroll taxes. And there may be occasion when you want to take a look at it on a weekly basis if things are very tight and you want to make sure that you know exactly what you're going to be able to pay and what's coming in. Do those weekly forecasts forecast as you go forward. Another best practice is daily monitoring of your cash. I'm sure most of you do that anyway, but there are some horror stories out there of issues with bank accounts because they weren't paying attention to the bank account. And I have actually experienced one myself way back when I was a controller for another firm. Is that one morning I came in and my bank account showed it was overdrawn, and it turned out that someone had forged a check that had caused our account to go from a positive cash balance of a couple $100,000 to a negative balance of about $150,000. And when we investigated a little bit further, the gentleman or the person that was trying to cash the fraudulent check was a horse seller down in Georgia. We somehow thought we had purchased a thoroughbred horse for our engineering firm, not necessarily a requirement to do engineering and bridge design, but something that did hit our books and was something that I was very proactive, glad that I was proactive in helping with monitoring the cash, because it did allow me to talk to the bank before they even realized that there was an issue with our account. We were able to talk with those folks, make sure that all the checks that were legitimate will be able to clear the bank without any issues. So, monitoring short-term cash flows, long-term cash flows on a regular basis is probably one of the more critical things that you need to do as you go through your daily responsibilities. So projecting methods, we don't have a crystal ball. If we did, it would be very simple to be able to have a crystal ball and do the work for us, but it doesn't. So we've got to come up with some methodology of projection. There's lots of different ways to do it, but do your projections. Obviously the best starting point for it is historical trends. Where have you been in the past? What levels of expenditures have you had? What level of cash receipts have you had? That's a pretty good indicator of going forward for what's going to happen in the future, and then you'll obviously have to adjust for new business here. Looking at the past give you some very good statistics here, because again, you're going to have some metrics on accounts receivable collection that will help projecting out how quickly you think you're going to collect the cash and be able to put it in your bank account. One of the best approaches, one thing to consider, is to take a very conservative approach when you're projecting your cash inflows. It's much better to under-promise and over-collect than the other way. It's very difficult at times when you have that issue, when you're planning on a lot of cash coming in and it shifts to the right on you a little bit. So taking a very conservative approach to those is probably a best practice that will minimize the stress and financial issues that you face when you're dealing with your owners or banks. As far as cash outflows, I wouldn't call it an aggressive approach, but I would call it more of a less than aggressive approach, a less conservative approach here for doing your cash flow projections, your outflows. There's a lot of reasons for doing that. You go ahead and plan on paying everything within the terms, having it ready to go. But if the cash is not available, it's much easier to slide or delay a payment to your vendor or someone than it is to get a client to pay and get the check into your checking account, so you do have the funds to be available. So, make sure that you do those kind of things to make life a little bit easier for yourself. When you're looking at your cash flow projections, take a look at a lot of different things here. I mean, obviously, most of you have annual budgets that are going to give you a good feel of what's coming up as far as expenditures. Hopefully, there's some timing aspects to it that will allow you to kind of get some peaks and valleys for expenses or revenue and receipts as well. And then again, also don't forget about your cost proposals. Taking a look at those as well. Some of them, obviously are going to be part of your budget you've planned for new business, but there may be that unexpected proposal that you go after that you have you feel you have a very minimal chance to get. But if you do, it could add 25% increase in your staff. Make sure that you have that on your radar as you're looking for it, because again, that is going to have a significant impact on your cash flow as you go forward. Take a look at the payroll and payroll taxes as well, and particularly the payroll taxes. You realize again that some of those taxes are going to be much more significant at the beginning of the year than they are at the end of the year. Everyone's going to have the full amount of Social Security and Medicare coming up, as well as the unemployment taxes that go on there. So you're going to have more cash requirements up front to pay those taxes. But as you go through the year, folks reach the limit for the unemployment as well as the Social Security portion of the payroll taxes. your cash requirements for as far as the tax deposits are going to be going back, are going to decrease throughout the year. Look for your capital asset purchases. There's also something that you'll need to factor in as your cash flow. And again, most of them focus on operating expenses, but don't forget those, because those are significant dollars that you're going to be investing in your company, and they will require that you account for them. And then again, line of credit payments. Make sure that's factored in into your cash flow forecast. Obviously, if you're dealing with a bank and you're borrowing money, they want to be able to see that you plan on repaying them back. It's probably one of the things that they're most concerned about is getting their money back so that they continue their business operations as well. As I mentioned a few minutes ago, we kind of do a couple things here at Neosystems. One of them is kind of this 30-day cash flow worksheet. And this is done in an Excel format here. And what we try to do is take a look at the next 30 days for our clients, what their cash requirements are. And on the left-hand side of the screen here, you're going to see a couple of tables, one that indicates a checking account and one for the savings account. Not really going to talk too much about the savings account, just from the simple fact that there's really not a lot of activity. Most of the activity is going to be occurring in the checking account. So the objective of this particular spreadsheet is to give someone, the decision maker in the organization, the tools to get a complete picture at what's going to happen for cash requirements over the next 30 days. A lot of systems, GCS Premier and CostPoint, some of those other ones, they're going to have your cash requirements reports, and that's going to be a valuable source of information, but that's not the complete picture that needs to be looked at when making a determination of what you're going to be able to pay or what you want to pay over the next 30 days here. On the left-hand side, you've got the, we'll pick a certain date here with a starting balance of this particular one. Maybe it's a little faded on my screen, so hopefully you can see it fairly well. But it has a cash balance at a particular point in time, and then it shows the cash receipts amount of about $400,000. What that is, and what we do for our clients, is in the next column over, and I've kind of got the mouse over here, is that gives the potential cash receipts. And this is coming straight out of our open AR report. We'll just dump it down into the AR, letting the client know that, hey, here's what's going to be coming in. We build this, and the collections are coming in. You have potentially an additional $400,000. But you need to take a look at this particular schedule here, because there's some details in there that may indicate that some of the receivables may not be showing up in the next 15 to 20 days when you may need the cash. Take a look at the first couple lines on here on job 1005. The original due date was November, and that's about $43,000, $44,000 worth of cash that's coming in here. Now, if we're in the middle of February and we're due in November, unless you know something that's going on, I would not really count on those coming in the next 20 days until I had a better picture of what's going on with those particular receivables. Then if you look at the bottom of the report here, you can see that a lot of these invoices for 10/10 and 10 through 10/15, they're not going to be due payment until the end of March. So you've got a period of time where you're going to have to wait for those to come in. So putting it in an Excel spreadsheet for the client here is we can just have them, they can delete the receivables that they don't think, by moving them out. It'll obviously reduce the cash flow, and then give them a more realistic picture of what's going to be coming in the next 30 days, so they can start planning on the next step. The first priority after determining what our cash receipts is going to be for us is to go ahead and take a look at the payroll. We obviously cannot miss the payroll. We miss the payroll, we've got bigger problems that are just going to spiral out of control. So, factoring and giving a view into what the next two payrolls are for the second half of February and the first half of March to the client, let them know what their cash requirements are, kind of gives them eliminates two of the variables and leaves the last remaining one for the potential cash receipts or the AP run. And over here on the right-hand side, you can start to see that, then again, it's the same thing that they have here. They have the ability to determine which ones they want to consider to pay within the next 30 days and give them a feel for whether they're going to need to extend or try to work with their subcontractor to say, look, I need an extra 10 days to pay this, or they'll be able to pay it. Just give them the opportunity to manage the cash with real data for the next 30 days or so. Traditionally, most folks will see this format of a cash flow type statement here, where you'll have specific receivables and disbursements listing on the left-hand column, and then monthly projections for each of the next month. This one here is running from April through September. And this is actually a living document, as I mentioned before. What we do for our clients as well, and provide them with a a document that basically provides actual information and then forecasted information and continually updated as collections come in and disbursements are made here. And just for visual presentation, we provide a highlighted column or gray out the column and then bold and italicize the numbers to realize that they know that those are actual numbers that have been paid out, and that if there's any questions on what the subcontractors were paid or what went into the professional fees, we will have specific check numbers and information for them to look at. Which brings up another point too. When you're doing these things, one of the challenges here is that most of us budget or plan by the major cost elements, salary and wages, fringe benefits, subcontractors, and so forth. When we actually write the checks, we're not writing them to subcontractors, fringe, salary, and wages, that we're writing to people and other companies, as well as the IRS and health providers. So it makes it a little bit difficult or a challenge here as you start to group those payments, because some of them are going to be very clear and going to end up in one line or the other, one line versus another line. But there could be a couple of them that may end up being could be in either line. And to make sure that you have a cash flow forecast that can give a reasonable data and information to them, you've got to make sure you match up your expenses in the line items. A good example might be you might have an accountant where you plan on putting their audit work in as a professional fee in the month, but they may have done a special project and supported you with an outside effort, and would that be considered a professional fee and other direct expenses? So, talking about making sure that you've got your payees lining up with your cost elements or your disbursement elements is critical to providing meaningful data to the end user of the cash flow statement. Managing your cash. Probably one of the biggest things to do is know the key metrics. The metrics aren't going to be the same for everybody. There's a lot of different metrics that you can use to control and monitor and project your cash, but understand which ones are going to give you the information you need to make the decisions that you need to make as far as what to pay and who to pursue for collections. Develop a proactive collection process. Don't wait until the invoice is due to find out that your PM or somebody forgot to attach a report to your invoice or send to the client, and the payment clock hasn't started until 2 days ago. Finding out 2 days before you're expecting payment's not a pleasant surprise to do. Take advantage of banking relationships. There's lots of ways that banks can work with you, and one of the things that I used to do in the past was that we had my boss, was a controller. He did not want to pay income taxes. Nobody really does, but he wanted to minimize them. And one of the strategies that we would end up doing towards the end of the year was to delay the issuance of our invoices so that the receipts would fall into January or February of the next year, which then obviously put it into the subsequent tax year, minimizing what we had to pay for the current year. Now that works real well if you have a very strong savings account or cash reserve, but if you don't, and you still want to try to employ that strategy, you're going to need to talk to a bank. A lot of banks will be willing to help you and work with that, because we were fortunate to have a partner that was willing to do that. We explained to them, probably about this time of the year, maybe into August, that this was our plan, that we're looking to probably towards the end of the year slow down the receivables, which means that our cash is going to be slowing down, our receivable base is going to be a little bit lower, and we may need some special financing, whether it's increasing the line, changing some of the terms, or a short-term separate kind of financing vehicle, depending on what the bank wanted to offer to allow us to get through that November, December time frame when we knew we would have a cash shortfall to make the payroll and other requirements that we had. And we set it up so that we'd pay in early February, late February, when we knew we were back in good shape as far as cash and would go through. And we had a successful strategy that ran for the 5 or 6 years that I was there. That was obviously worked out real well. And again, having a bank that understands your business and is willing to work with you is critical. The government contractors are unique animals as far as when it comes to banking. Having a bank that understands that is a valuable partner for you. The other thing that can kind of sneak up on you is those unexpected tax payments. The BPOL, the Business Professional Occupation Licensing one. Estimated income tax, if you have to pay them, those obviously can be a cash drain, because those can be some significant dollars depending on the size of your liability or or the revenue base that you've used to calculate your B poll tax. So make sure that you understand and know when those are coming in and include those kind of things. And then obviously, avoid fines, penalties, and interest that does nothing but suck cash out of the checking account with really not much benefit for you. As I mentioned a few minutes ago, metrics, and I want to take a few minutes to take a look at some of them here and talk a little bit about them. A lot of folks monitor these on a regular basis for a lot of reasons, but utilization can kind of indicate a trend in cash here. Obviously, as you go up in your utilization and you've got people being billed more, then that's going to in turn generate higher receivables for you. But if you're going through kind of a downtime, you need to make sure you understand why. If you look at that chart there from February to April, it's gone up almost 10% in the utilization for this particular company. Make sure you understand why that is. Maybe that utilization is people that were on the bench that you were waiting for a contract or contract option have now been utilized and now billable, and so therefore your payroll and your expenses are going to be the same, but you're now going to have a stronger cash flow because you're going to be able to bill more. Or is the increase in utilization due to the fact that that new contract came on, you started hiring people, and your people are ramped up, and you've got higher utilization because the people you've hired are 100% billable. Now you've got that payroll for the first couple months or the first 2 or 3 payroll periods, and you really are not going to be able to bill until you complete the first month of service, and then you've got 30 days after that. So understand what that utilization is telling you as far as the driver for your cash flow. Days sales outstanding, that's probably one of the most common or most used metrics as far as measuring the time it takes to convert a sale into cash here. And you can see that this particular example here, there's a couple of mountains. It looks like a mountain range here, and there's a couple peaks and valleys in here. And understanding what's going on with those things, it may not always be the same reason that's driving up the number there from in January it's at 64, and then up in March it's 73, and then you can see it drops back to 67 in May up to 77. There could be 2 completely different reasons for the increase in the days. And if you look at think about maybe the first quarter, maybe that your accounting staff do year-end audits, W-2s, 1099s. They were a little bit late in getting some of the bills out, and so the payment process went all the way through. But the invoices went out the door a little bit later than they normally would have, which would have caused obviously your sales, the day's sales outstanding to go up. Down in September, you're not going to have those year-end requirements. There might be something else driving it. That could be something where there could be a customer hasn't paid you, or you had a significant invoice that's taking a long time to get through the payment process at a customer site. So, understand exactly what it's telling you, and there is good news and there is bad news, but you may need to understand what's causing and driving the good news and the bad news. Revenue is also another metric that folks may use as well. Knowing what your revenue, again, is obviously going to be an indicator of what your future receivables will be. But remember that your revenue consists of 2 different things here. You have your billed revenue, which you've been able to bill in a timely manner, and then your unbilled revenue that you may not be able to bill for another 30 days, either because it's a milestone type billing, and you have to 2 more steps to complete before the customer will allow you to bill for the entire one. So gaining an understanding of the breakdown and split between the revenue is key to understanding whether this is a good metric for you as far as a future indicator of your cash flow. Looking at your indirect rates is also another good metric too, and there's a couple things going on with this thing that you might want to pay attention to as you monitor them here. I guess it's an olive green line here, kind of represents the provisional rates for each of the different pools. The light blue represents the monthly spending, and the year-to-date is represented by the dark blue line here. The light blue obviously can tell you a couple things here, because if your spending's down 30 days later, your cash requirements might be a little bit lower, because you're obviously going to have 30 days to pay all of your vendors and suppliers for the expenses that were incurred in February. So just realize that there is a difference between your actual spending and the cash. It's that timing difference that we talked about at the beginning, the difference between accrual and cash basis. The other big thing to worry about or to look at here is the difference between the year-to-date line and your target line, especially if you have a CPFF contracts here. Most of you, those gold lines olive lines will represent your provisional billing rate. So you're sending out bills on your cost reimbursable contracts for CPFF contracts, and if you're burning or spending at a lower rate that for the year to date, you potentially are obviously overbilling your customers there. And understanding the difference and minimizing that is important, especially when you get towards the end of the year, because at the end of the year you're probably going to end up doing a rate adjustment invoice, and if you're over and you have additional cost to bill, that will obviously help your cash flow. But if you've underrun or overbilled your customer, you're going to have to give a credit or possibly write a check back to the customer in the first part of the next year, which is obviously going to have an impact on your cash that's going to be going out in the next quarter. So understanding and managing these rates and minimizing from that perspective will be beneficial to your cash flow forecast if you have CPFF contracts. Some tips. Obviously, making invoicing a priority at the end of the month is probably a very obvious tip to most folks here. But there's a couple things that you can do to expedite and make and assist with the preparation of the invoice. And it all goes back to the thing most government contractors here as far as make sure you complete your timesheets, get them in and signed and approved by the end of the timesheet period. For us, that's the major source of information that's going to go through the billing system. It's got the hours and the labor cost and for be included in your cost plus contracts, and then obviously you have your labor categories for billing your time and materials. Make sure that those are going through. Consider adding your subcontractors or consultants to your timekeeping system. A lot of them now a lot of companies are doing that, which then allows you to get that information in there, not having to wait for your subcontractor's accounting department to send you the invoice so that you can process it through the AP to record the hours in the system. They're already in the system and available for inclusion in the bill. Another good idea might be to establish cutoff dates as far as expenses. If you've got an invoice that's a significant amount, maybe $30,000, $50,000, $100,000, whatever's a significant amount to you, don't hold it up for the $200,000 to $300,000 or $2,000 to $3,000 invoice that you're looking for. Go ahead and establish the cutoffs and bill that the subsequent month. It's better to have the $100,000 in 30 days than wait for another 30 to 30, an additional 15 days to get the $102,000, $103,000. Monitor your AR and look at your receivables issues. We did talk a little bit about the issues from the technical side. Now, believe it or not, most of you will probably be surprised, but Wide Area Workflow has some issues that go through that system. They make mistakes with acronyms and funding documents. Take advantage of the My Invoice system, all of the online reporting capability that they have as far as telling you where the status of the invoice is. Knowing shortly after it's submitted that there's a funding issue that you have an additional 20 days to fix and correct, as opposed to getting to that 30th day, counting on that money to come out of Wide Area Workflow, not going to have it there is important and will help with your cash. Manage your accounts payables and your disbursements. Have solid purchasing policies and procedures for the company. Limits and controls and reviews will be is a great way to control spending, which will obviously have an impact on helping your cash. Use company credit cards if it's practical. Now, a lot of folks will do that. What that does is if you have folks that are on travel, issue them a company credit card. Prevents them from having to require a cash advance coming out of your account. That's obviously something that saves time for your accounting department. They won't have to issue the check or prepare the EFT transfer, but they can use their credit card. One thing that I would recommend and suggest is to have the employee responsible for payment and have them submit reimbursement, expense for reimbursement to the credit card. Don't pay that on their behalf, and let them monitor the control and the payment of the card here. Make sure it's practical use of the credit card. Don't use credit cards to finance your operations. It just has a spiral effect. I've seen it a couple times where clients have tried to use the credit cards to keep their operations going, and then they're successful a short period of time, but eventually you start getting a significant credit card balance, and all you're doing is making the monthly payments. You're not really making much headway as far as to improve your cash flow and the viability of your business. And if at all possible, avoid factoring. It's just a very expensive way to do it, to finance your business. It may be necessary to survive. Do it, but get off as quickly as you possibly can for it. Next thing, we'll talk a little bit about cost cutting or cutting expenses. probably one of the more difficult things to do. And obviously, there's a couple key triggers that you're obviously going to be looking for is that will determine what action and how severe you have to take here. And that is if your cash disbursements consistently and significantly exceed your cash outflow, your cash receipts. You're going to eventually, that savings account, if you're fortunate to have one, or the investment account is going to eventually dwindle down to zero, and then your line of credit may then turn around and max out where you're going to be pretty much stuck. So you're now going to have to find ways to reduce your expenditures and levels here. Watch for loss of contracts. And unfortunately, a lot of us are experiencing contracts that are not being renewed. You'll get sometimes 90 days notice. Start planning ahead, see if you can start cutting costs there just to have a little bit extra reserves when you get to that point when the revenue stream stops. The two big areas that you can look at, and one is a little bit easier than the other, is discretionary spending. Obviously, that's easy because it's discretionary. Most people understand when you're cutting back on those type of expenditures that you're just tightening the belt a little bit to continue this side to survive. The big thing is downsizing. Cutting people. That will have the desired effects as obviously cut down your cash flow, but it will have a morale issue and an issue that you have to keep good control and understanding of what's going on with your company. We've been through it several different times where we've had to let folks go, and all of a sudden you start to see some impacts that are a little bit not too flattering, things that you're a little bit concerned about. The folks that remain behind are always going to have the "am I next" concern. Usually there's a line at the HR door wanting to talk to the HR person, knowing that they need to start looking for a job because their next door neighbor in the cubicles there got their notice last week. All kinds of things, morale issues that range from, I've got the same, now we have twice as much work because we have less folks being able to do the work here, and then obviously then you've got problems with employee recruiting and retention here from a couple different perspectives here. You may have had to cut some costs, but you're looking to possibly hire that key person that you need to fill a technical position or some critical role, and if you've had to cut back benefits package, either increase a deductible or cut back some type of benefit, health insurance coverage, change their pay, or even cut the bonus program or eliminate it, reduce it, that's going to have a negative impact on being able to retain and as well as recruit additional folks, because folks that are used to having that are not going to be interested in coming to join you, and then folks that you have currently on staff, they're going to want to find another possibly source and know when their bonus is coming back to them. The bonus program is going to be re-implemented. So it is necessary to do the cost, but probably one of the big things, or the tip that I probably would offer to most folks, is make sure you communicate with folks. Don't let the cash crunch be the elephant in the corner that everybody's looking over the shoulder to try to determine what's going to be happening next with it. Put it in front and center. Let them know what's going on with the company. Obviously you've got to limit the type of information, but communicate with them, talk to them, let them understand what's going on with it, that we're doing the necessary things that we can survive and move forward and run the company more efficiently. So there are some real plus benefits from communicating with the employees. It's going to relieve some of that cloud, give them some encouragement and excitement for the company that they are going to get through it, and that things are going to go back to the way they were a year or two ago, or prior to the temporary the cash crisis. Kind of wrapping up here a little bit, cash has not abdicated the throne yet. He's still the king. It doesn't look like it's going to change anytime soon here. That acronym, that slogan is going to change here. One of the things that you can do to help move things on is look for trusted financial advisors, whether it's someone that you worked with in the past that started their own, that's been through the trials and tribulations of starting a business, trying to figure out how to come up with cash and meet payroll and all those different things. Or they may have options, availability for creative financing options, mezzanine financing, secondary markets, all of the different things that are out there that you may not be aware of, that you can take advantage of. Those folks that have that information can bring that information to you, so that you will have the basis for providing a solid financial decision process here. And then probably the other key point to take away here is to have solid business systems and internal controls. Not only does it provide a great basis for the metrics and information that we talked about a little bit before, but if you're going outside to mezzanine finance, or you're going outside to to a bank. If you have a solid control and handle on your purchasing and your accounting, you can provide timely reports that show them the amount of receivables that you have broken down by the different categories, that you're going to be able to produce a borrowing-based certificate or other financial information that they want to have to monitor as you go forward. It's going to be an asset to you as you go through it, and will be one of those boxes that they're looking to check on the bank. You know, obviously, then if you're successful at it, it gives you the resources and resources to be able to go ahead and invest in your employees or your infrastructure. We put it back into your company. You know, maybe you've had to cut that bonus program or that benefit. Now putting that back in is going to have a tremendous impact on your morale. So once you come through and are able to do that, you're going to have a lot of different opportunities to invest and use those resources that you have been able to acquire. And hopefully, if you have a positive cash flow and you're successful at it, it will reduce your financial stress. It's probably not going to reduce your overall stress, but hopefully at some point it will reduce your financial stress to make life a little bit easier so that you're not having to worry about finance from midnight to 2 a.m. every morning. And so with that, I'm going to turn it over to Brian, and he's going to conduct the second poll question.
Thanks, Jerry. Jerry's done a great job of running through the various approaches to cash flow forecasting and cash flow management. Getting to know you guys a little bit better. You know, what cash flow management challenges are you experiencing? Are you having issues with your DSO running a bit high? Is it the employee utilization? Are you reaching your upper limit on your line of credit? Are you having challenges submitting your contract compliant invoices in a timely manner? There's two pieces to that. Getting the invoice out on time and also having it be compliant so that you get paid in a timely fashion. Or we don't have all the answers here, so maybe there's some other challenges that you're facing. If you are facing another challenge, check that box, and then what you can do is just write in the questions box what your challenge is, and you know we'll be able to take a look at that. All right, we're getting some good results in here. So what I'm going to do is I'm going to give you another 5 seconds to fill in the poll. 4, 3, 2. A couple people always come in like at 2. It's amazing. All right, I'm going to close the poll. So, interesting. Some of you with a high DSO, some of you with an employee utilization, all interesting challenges. And yeah, you know what? Not a surprise there. You know, submitting those compliant invoices in a timely fashion, very typical. And Jerry, did you want to add something in there?
Yeah, one of the things that, you know, for those folks that are struggling with the compliant issues, compliant invoice and submitting in a timely manner, one of the things that may help you looking at is determining what your customer client decides is a proper invoice. You know, a lot of the contracts are going to have the requirements of defining what a proper invoice is. If they were going to, you know, if you're a subcontractor, the contracting documents will usually have what the prime contractor's internal project number is and other requirements that you can put in there. So looking at your contracts or your purchase orders is going to be a good start to give you not only what the customer wants to see on the invoice as far as the required information, but it will also give you the list of who should be copied on the invoices. And a lot of folks want multiple people receiving your invoices and reports. So looking to that contract document may be a partial solution to having your compliant invoices get out and understanding what the requirements are for each of your invoices.
That is so true, Jeff. Just reminds me of, you know, the old thing that, you know, the customer is always right.
Yeah, there's a few times when that happens.
Yeah, so if they want the invoice a certain way, that's the way it's going to be, and
you know,
especially if it's in the contract that way. Jerry's done a great job and provided a lot of information, but we also have other resources available to you. Some of them free, some of them, you know, we do charge for. But we have Neosystems, we have training, these webinars like you've been on today, they're free and available to you. We have some that we've recorded, they're available on our website. We also have courses on GCS and other areas that could be helpful to people. We also have a blog on our website, so please visit our website. We have blogs specifically on cash flow, but we have them on a variety of topics. So whatever is your issue, please feel free to take a look at it and subscribe to our blog. We put out our news and notes. We also do industry events. And if you ever have a question, you can just email us at growahead@neosystems.corp, but you can also just email Jerry and me as well. I have one more thing to share with you today. Jerry mentioned the DSO and that it's one of the most used areas, and some of you from the poll, it was one of your areas that was one of your biggest challenges. So one of the things we said was, hey, why don't we try to help people out here? We're going to offer a complimentary DSO analysis. So if that would be something of interest to you, we would be happy to help with it. Just something that you can do, and please, if you'd be interested in the DSO, no strings attached, it's free. If you're local, we might come over to your office, we can do it over the phone, take about an hour of your time, do a DSO analysis, something that we can share with you. All right, so about 5 more seconds on, if you're interested in that. Now I'd like to open it up to your questions. If you have any questions, please feel free to share them with us. That's what we're here for. Any questions you want to address there, Jerry?
I guess one of the challenges of creating and maintaining the Excel spreadsheet and cash flow, that is probably the most difficult aspect of it here. I mean, there's a lot of ways to do this. I think the best way is to, what I like to do is to basically create a sort of the master one. The example I showed that had the monthly amounts in there, kind of use that all formula driven so that you're not going in there and putting data in there. Have those formulas and build some tabs off on the side that may list your specific cash receipts that you're expecting on there. The overthing, kind of your sandbox or play area where you're not going to blow up a formula that all of a sudden you end up eliminating or forgetting to include a particular cell in the range, and it throws everything off here. So, that's probably the biggest tip as far as working with Excel and using it, taking advantage of technology and separating the different disbursements, receipts, payroll onto different tabs so that you do have the opportunity to play with it out without blowing up your spreadsheet that's going to be required fairly quickly.
Yeah, certainly I've built a number of spreadsheets in my day, and yeah, I also build in some checks, this equal this, and then it puts up on the front to make sure that all the totals tie out, because I'm sure we've all deleted a row or added a row and added a column that all of a sudden isn't getting added that needs to. So from a technical point of view, that's one of the tricks I've always done.
Save frequently.
Save frequently. Thank you.
Major changes, just save frequently. I mean,
that is true as well. And we also got the question in about will the presentation be available? We are recording today's presentation, so we will be getting that out to you, and it'll be available on our website as well. And we also had a question about, talked a little bit about when you do have success and you start getting cash flow in there. How would you prioritize cash investments?
Well, I guess you have to take a look at the company here. Probably the first priority to me would be, is if you're at that point, would be considering to reinvest it in employees, whether that's reinstating the bonus program or incentive payment program or changing the deductible. Something that has a direct impact, a positive impact on your employees' paycheck is probably going to be the best way to get the best bang for your buck from the additional resources that you have here. And maybe if that's not, if you're didn't have to cut back on that, you just had to cut some other infrastructure, then obviously then you start looking at the other uses of putting it into your, laptops, infrastructure, whatever else you need, the technology you need so the employees can do their job efficiently. So it's almost where it's going to give you the best bang for your buck there. And again, I've seen it many times. People are extremely excited and motivated again once their bonus program is put back in place. So probably that's where I would start.
Okay, great, Jerry. Thank you. Good advice. And so if you have any more questions, please feel free to email Jerry or me. I want to thank everybody for attending Neosystems webinar today, the Introduction to Cash Management. We covered a lot, from calculating forecasts to managing your cash, but there's so much more. So again, if you have questions, please feel free to email us. And again, on behalf of Neosystems, thank you.